US President Donald Trump has requested Venezuela's newly installed leader, Delcy Rodriguez, to ensure that the United States has total access to the country's natural resources, including oil, adding that the US, through its companies, will invest billions of dollars in the country, claiming that it will be for the citizens' benefit. Trump has invited US oil companies to go back into Venezuela to invest, but Professor John Stremlau of Wits University expects a level of caution among these companies, especially given the circumstances under which the country is being persuaded to cooperate.
I think that the companies will be very cautious in re-engaging Venezuela. I don't know, obviously, what consultations went on between Rubio's people and the companies.
Economist Iraj Abedian says there are two key economic dimensions to look at in light of the latest developments in Venezuela, and at this stage doesn't expect much in the way of oil supply disruptions and price risks.
One is from the price of petrol, what might happen in the short and medium term, and the other one is the instability, uncertainty, and political risk that this event injects into the global economy, which is already full of risk and uncertainty and really troubled zones. From a price of oil point of view, it's a non-issue. The fact is that the past 10 years, the reliance on fossil fuel has declined. Over the past year alone, the price of oil has lost almost 25% of it, from just below $80 per barrel to today's around 57.
Asked whether investors have simply become desensitized to negative geopolitical news, Abedian says that's not the case, as market players look at a number of factors ahead of a major event, helping them to properly price relevant products like crude oil.
They've discounted that in the prices. They know that some sectors are going to be in trouble. Some sectors like oil and energy more broadly are going to be favorable. They've accepted that the price of dollar currency is going to be under pressure, if you like, the foreign value of currencies. And therefore, all those are in the market already. And those risks are factored into the pricing mechanisms as far as currencies are concerned, as long as commodities are concerned. And that's the reality of how the markets operate.
With the US dollar expected to continue losing value this year, this is said to be positive for emerging market currencies like the South African rand. And with the oil price currently losing steam, this combination is set to augur well for fuel prices in the short term, helping to place downward pressure on domestic inflation. However, concerns remain that should the US pursue other adversaries like oil-producing Iran at a later stage, this could then result in supply disruptions and ultimately push up prices. But for now, current fundamentals suggest that global supply currently exceeds global demand. Dampamela Ziziba, SABC News, Johannesburg.